In this video, we are going to be discussing stock dividends and stock splits. What a stock dividend is, a corporation can give every single shareholder an additional share. So for example, a 10% stock dividend would give each shareholder an additional 10% of shares. So if they owned 10 shares before, they would now own 11 shares of the same company. So no one's total percentage of ownership actually increases. The first thing that we need to understand is that it is very different from a cash dividend. There is no cash involved with a stock dividend. What a stock dividend does is it recapitalizes retained earnings. In other words, you'll be shifting something from retained earnings to a contributed capital account. The entry is debit retained earnings, credit common shares, as an example. However, a stock dividend is a way for a corporation to give their shareholders something without having to use up any cash. Another advantage is that a stock dividend can reduce the market price per share. And you might be wondering, why would anyone ever want to do that? Well, a reduction to the market price per share could end up increasing the demand for those shares as the price goes down, and then over time increasing the price again as the demand increases for the fixed supply of shares. A preferable way to do this, though, is with a stock split. What a stock split does is it gives everyone more shares. So for example, a 2-for-1 split would give every shareholder that has one share an additional share, 2 for every 1. They would now have 2 shares for every 1 share that they had. So that shareholder we talked about earlier, if they had 10 shares to begin with, a 2-for-1 stock split would mean they would have 20 shares after the fact. This would do some of the same things. It would reduce the overall market price per share, at least for a little while, and that would theoretically increase demand for those shares at the lower price point, driving the share price back up, ultimately benefiting the shareholder. Another advantage is this would not create a taxable event for the shareholders because nothing in retained earnings is getting shifted from retained earnings to a common share account. Retained earnings is untouched. In fact, a stock split doesn't have any journal entries at all associated with it. Let's take a look at an example where we go through both types. This is example 14-1. And the background is 14-1 Inc. has a number of equity transactions in 20XY. Record the journal entries, if any, for each item described below. So in January 1st, 14-1 issued 20,000 common shares for $15 a share. We aren't told anything about brokerage expenses in this transaction, so we'll ignore them. But typically there would be some sort of brokerage fee for issuing shares into the market. The entry in this case would be a debit to cash for 20,000 shares multiplied by $15 a share, or $300,000, and a credit to common shares for $300,000. Moving on to Jan 5th, issued $15,000 of $1.25 cumulative preferred shares for $20 a share. Again, we'll debit cash for the amount received, $15,000 multiplied by $20 a share, once again, it equals 300,000. And we credit preferred shares for 300,000. Next, on February 17th, declared a 10% stock dividend on the common shares. Now, it's important when faced with something like this that you understand how many common shares were in existence, issued and outstanding currently for the corporation prior to this stock dividend. That number is what you are going to take 10% of. Going back to the question, it says here, prior to this year, there were 30,000 common shares outstanding. In the first part of this question, 20,000 more common shares were issued. So if we have a total of 50,000 common shares, we know what to do. We can debit retained earnings for 30,000 plus 20,000, so 50,000 common shares, multiplied by 10%. That's the number of common shares that are going to be issued, or in this case, 5,000. And multiply that by the market price per share at the time, which we're told is $15. So we debit retained earnings for $75,000 and we credit a new account, common stock dividend distributable, for the same amount, $75,000. The reason we're not using a dividend payable account for this is because nothing is actually payable with cash. These shares are going to be distributed. So common stock dividend distributable is not a liability account. It's actually a temporary equity account. And that's important to remember. Temporary equity account. Next, distributed the stock dividend that was declared on Feb 17th, and this is happening on March 1st. Well, we debit that new account, common stock dividend distributable, for $75,000. We credit common shares for $75,000. On March 30th, 14-1 Inc. split their common shares 2-for-1. Well, we know that they had 50,000 shares outstanding prior to this, and now they're splitting them 2-for-1. So even though there's no entry, because it's a stock split, you might want to make a note for yourself. Stock split, 2-for-1, 50,000 times 2. You now have 100,000 common shares. Finally, on April 1st, declared a $100,000 dividend. Prior to this year, there were no preferred shares issued and outstanding. We need to go back up to the very beginning of this question, or near the beginning. On Jan 5th, 15,000 preferred shares at a rate of $1.25 were issued. That means we can determine how much of that dividend is going to be payable to the preferred shareholder. Recall that dividends are declared from retained earnings. We are given the amount of the dividend. It's $100,000. We can credit dividends payable, preferred, and we can work out what it's going to be. There's 15,000 preferred shares at a rate of $1.25. That's 18,750. Everything else will go to our common shareholders. Dividends payable, common. So those are a few of the transactions and basic considerations for stock dividends and stock splits. So I hope you found that example to be helpful. Thanks for watching, and I'll see you next time.